Is the bear market over 2022? The S&P 500 made a recent low of 3636 in June, dropping 24.5% from its all-time high of 4818 set in January. Since then, it's had a powerful rally up 14% from its low. Is the bear market over in 2022? Or is this just a bear market rally that eventually makes new lows? In this video, I'm going to explore 3 reasons why the bear market might be over, and we may have seen the bottom in June. Then I'm going to give 4 reasons why this might just be a bear market rally and we might not see a bottom until at least March of 2023. And finally, I'm going to go over my game plan to invest for both scenarios. All this right after. I am not a financial advisor. This video is for entertainment purposes only. Learn to invest like a wolf at your own risk. What's up, everyone? Welcome back to my channel, Wolves of Investing. My name is Donnie Nguyen and I'm the founder of Wolves of Investing. If you're new, I talk about stocks, SPACs, Bitcoin, options, and anything on my mind related to investing. If you want to learn how to achieve financial freedom through investing, be sure to click on that subscribe button and notification bell if you haven't yet. And please remember to drop a like on this video if you enjoy it, as it truly helps out the channel. So without further ado, let's get right into it. Here are 3 reasons why the bear market might be over. Since 1950, the S&P 500 bear markets appear to have fit neatly into 2 categories: short and long. Short bear markets found a bottom in 6 months or less. Long bear markets took a minimum of 14 months to find a bottom. Currently, if the June low holds, then this bear market will fit into the category of short bear markets, having found a bottom in 5 months, which is in line with history. The second reason the bear market might be over is the chart indicator called the percent of stocks above their 200-day moving averages. This data goes back to 2002, and in each of the bear markets, this chart bottomed below 20% at around the same time that the bear market bottomed. In this current bear market, the chart hit a low of 14.3% in June, which could indicate that the bottom was in. Since 2002, the only time we saw a head fake in this chart indicator was the Great Recession in March of 2008, where the market went on a massive bear market rally before bottoming 12 months later in March of 2009. Back then, this indicator hit 14%, then rallied all the way back up to 43% before falling to a low of 3%. If this current market follows the same pattern as the last 4 out of 5 bear markets, then June may have very well been the bottom. And for those of you keeping track, I'm counting every 20% drop from a major high in the S&P 500 as a bear market. Even 2018, which was an intraday low, and 2011, which was a bear market within a bear market. The third reason why the bear market might be over is that inflation might actually have peaked, which will allow the Fed to stop raising rates. The July inflation readings are coming up soon, and they could show that inflation eased. Core CPI, which does not include food and energy, is one of the main things that the Fed looks at, and it's been dropping since March. The March peak was 6.5%, and it's fallen to 5.9% in June. If we see a major drop in July and August, perhaps to 5% or less, that could signal that the Fed's rate tightening is working and that they might not need to tighten much further to get back to target 2% inflation. Core PCE is also one of the Fed's favorite inflation readings. It was 4.8% in June, and we could see a major drop in July or August, perhaps to 4% or below. Now that we talked about why the bear market might be over, let's take a look at a few reasons why this might just be a bear market rally and we may see new lows before we see a full recovery. The first reason is by technical analysis. In a trend, whether it's downward or upward, often there will be a retracement that finds resistance at key levels. This powerful rally that we've seen in the S&P 500 since June could just be a retracement. And the two key levels of resistance that it might run into are the 50% retracement and the 61.8% Fibonacci retracement level. There are also two more areas of resistance coming up: the 200-day moving average and this downward facing trend line that I drew here. If these areas of resistance hold up, we could see the bear market rally come to an end around the 50% at 42.26 or the 61.8% at 43.66. The S&P 500 closed on Friday at 41.45, so we're getting very close to these potential areas of resistance. That's what happened in 2008. We saw the S&P 500 rally powerfully after dropping 20%. That rally stopped 7 points short of the 61.8% retracement level at 1440 versus 1447, before ultimately making a 58% drop from all-time highs. A second reason that the bear market might not be over is that the S&P 500 hasn't touched its 200-week moving average yet. In 12 of the past 13 bear markets since 1950, the S&P 500 touched its 200-week moving average. If the S&P 500 follows this powerful pattern, I would expect this to happen before a full recovery can occur. A third reason the bear market might not yet be over is the inverted yield curve. According to this chart at the St. Louis Fed, the inverted yield curve has predicted the last 6 recessions since 1980. Within 2 years of the yield curve inverting, the US has gone into a recession. It only gave one false reading in June of 1998, where there wasn't a recession, but there was a short-lived bear market that had a drop of 22.4%. And the fourth reason why the bear market might not be over is that inflation might be worse than expected. If the July and August inflation readings don't show any major signs of improvement, the Fed will have no choice but to keep tightening. We could see the Fed funds rate top 4% this year, and even 5 or 6% in the next 12 months. We haven't seen those levels for over 15 years. This could cause the market to see new lows and fall into the long bear market category. In that situation, if it follows history, we may not see a true bottom until at least March of next year, which would be 14 months from the January peak. All right, so what is my game plan? So I'm in the camp that this is just a bear market rally, and I'm leaning about 60% that way. In my opinion, there's about a 40% chance that June was the bottom, and about a 60% chance that we're experiencing a bear market rally. However, history has also taught us that time in the market beats timing the market. The last 100+ years of the S&P 500 chart has been up and to the right. So I'm not planning to make any major moves in my portfolios. I separate my portfolios into long-term holdings, which I don't really want to mess with, and I plan to hold long-term for at least 10 years, hopefully 15 or even 20 years. These are things like my S&P 500 index fund and my Russell 1000 index fund. I just plan to keep passively dollar cost averaging into those, and maybe even get more aggressive if we go into a deep bear market, if I'm able to. Before a portion of my individual stock accounts, I do actively trade around my positions. In those accounts, I need to ask myself 2 questions. If this is truly a V-shaped recovery and the bear market is over, do I have enough allocated to long-term positions to take advantage of a newly formed bull market? The second question is, if the bear market is not over and continues to make new lows, do I have enough sideline cash to buy more stocks at lower prices? So for me, for my risk tolerance and my 10+ year time horizon, I feel like having around 10 to 20% sideline cash in my individual stock accounts is about right for now. If the market shoots higher from here and goes into a raging bull market, 80 to 90% of my stocks should benefit. But if the market gets worse, that 10 to 20% sideline cash will allow me to continue buying the dips. So as I mentioned in a previous video, I was aggressively buying stocks when the S&P 500 dropped 20%. And now that the market has been rallying, I've been taking some profits to raise more sideline cash, which is currently between 10 and 20% in two of my main individual stock portfolios. Is the bear market over? Or is this just a bear market rally? Of course, no one has a crystal ball, but let me know what you think in the comments. Thanks for watching, and I will see you next time.